Welcome to this explainer. Today, we're going to unravel what I think is a truly fascinating financial mystery. We're looking at the raw data for Crescent Energy, trading under the ticker CRGY. And honestly, on paper, this company presents one of the most perplexing financial profiles on the market right now. I mean, how exactly can a company be a massive winner for investors while simultaneously flashing some really glaring fundamental red flags? Let's find out. Okay, let's dive right into this. 57.01%. That's Crescent Energy's year-to-date return. If you've been holding this stock, well, you're having a fantastic year. A return pushing 60%? That's the kind of momentum that gets everyone's attention. And a trailing 12 months total return of nearly 61% is even more impressive. So naturally, you'd expect the underlying earnings report to be absolutely stellar, right? Well, here's where the story takes a really sharp turn. On one hand, we've got that glorious 57% year-to-date return. But on the other, a trailing 12-month net income of negative $284.79 million? Yeah, negative. So here's the crucial question. How on earth is a stock surging nearly 60% in a single year when the company is bleeding almost $300 million in income? It is a classic market paradox. To solve this mystery, here's our roadmap for today. First, the Crescent Energy paradox. Then, valuation. Cheap or a trap. Third, the cash flow engine. Fourth, liquidity and debt health. And finally, the dividend profile. So, Section 1, the Crescent Energy paradox. High returns, negative earnings. The market just seems to be completely ignoring some, frankly, terrible profitability metrics here. The trailing 12-month return is a robust 49.06%, yet the net profit margin is sitting at negative 1.06%. And it gets worse. The return on equity is negative 6.09%, and the return on assets is also deeply in the red at negative 2.61. Usually, negative ROE and negative margins are massive, flashing warning signs. Yet, investors just keep bidding the stock up. Why? That brings us to Section 2, valuation. Cheap or a trap? Let's look at pricing Crescent Energy. Now, what's really fascinating here is the dramatic shift we see in the price-to-earnings ratio. Because the company is currently losing money, the current PE ratio is a dismal negative 17.39. But look at the forward PE right next to it, 7.84. This tells us a story of just massive optimism. The market isn't pricing Crescent Energy based on what it's doing today. It's pricing it on the expectation of a massive profitable turnaround in the near future. A single-digit forward PE suggests that if those earnings actually materialize, this stock is exceptionally cheap. And, that theory of undervaluation is actually supported across the board. Just look at these valuation multiples. The price-to-book ratio is 0.92, meaning the stock is actually trading for less than the theoretical liquidation value of its assets. The enterprise value to EBITDA is just 5.29, which is really low. But the absolute real standout here? The PEG ratio of just 0.26. Typically, anything under 1 is considered undervalued relative to growth. So a PEG of 0.26 implies the market is pricing in either extreme undervaluation or utterly massive growth expectations. Let's move to Section 3, the cash flow engine. This is where we find the real story. We already know the net profit margin is negative 1.06%, but take a look at the core business itself. The gross profit margin is an incredibly healthy 56.27%. This means the actual cost of goods sold is really well controlled, but paper losses, things like depreciation or non-cash charges, are likely what's dragging down the net income. Because when we look at the actual cash being generated, the company pulled in almost $374 million in free cash flow over the trailing 12 months. They might not have accounting profits, but they have serious, undeniable cash. And this brilliantly illustrates exactly what the market is cheering for: explosive free cash flow growth. Over a 5-year period, the compound annual growth rate is a very respectable 29.26%. But over the trailing 12 months, an explosive 148% growth in free cash flow. This sudden, massive surge in actual cash entering the business is the real engine driving that 60% stock price return. Which leads us directly to this number, 8.69%. That is Crescent Energy's free cash flow yield. To put that into plain English, if you bought the entire company today, it would generate nearly 9% of its purchase price in cold, hard cash in just one single year. While the earnings yield is negative 6.62%, the free cash flow yield proves the company has incredible operational health, just underneath the surface.
All right, on to section 4, liquidity and debt health. It's time to look at the hidden risks.
Let's start with liquidity. Both the current ratio and the quick ratio are sitting at 0.57. Now remember, a ratio of 1.0 means you have exactly enough liquid assets to cover your short-term liabilities. Crescent Energy only has 57 cents for every single dollar of short-term debt coming due. That represents a very real, significant short-term liquidity crunch. They're literally operating on a razor-thin margin when it comes to those near-term obligations.
And to make matters worse, that liquidity issue is compounded by their broader debt levels. The debt-to-equity ratio has actually crept up recently. The trailing 12-month average was 0.96, but currently it sits at 1.12. An increasing debt load paired with weak short-term liquidity, that adds a massive layer of risk to this financial profile. Basically, if that cash flow engine ever stalls out, this debt could become very heavy very quickly.
Finally, Section 5, the dividend profile. Let's talk about rewarding shareholders.
So, they're paying a pretty solid dividend yield of 3.68%. Now, if you only look at the standard payout ratio, you'd probably panic. It's listed at 100%, and the 3-year average payout ratio is a terrifying 234%. You'd think the dividend is totally doomed. But again, accounting earnings are deceiving us here. When we look at the free cash flow payout ratio, it's only 42.36%. This proves that despite the negative accounting net income, the dividend is actually comfortably covered by the massive cash the business is throwing off.
So, what should you really take away from all this? Well, Crescent Energy is basically a masterclass in why you can't just look at net income to understand a stock. The market has rewarded CRGY with massive year-to-date returns because underneath the negative profit margins lies an absolute cash-generating machine with deeply discounted valuation multiples. But of course, that reward comes with a catch: creeping debt and a severe short-term liquidity crunch. So I'll leave you with this question to chew on. As an investor, does an explosive, growing free cash flow engine justify taking on those glaring short-term debt risks? Think about it, and we'll catch you in the next explainer.